More than Karan Gupta, Director and Head of Financial Institution at India Ratings and Research. Karan, a very good afternoon. Thank you so much for joining in with us this afternoon on ET Now. Karan, I want to start by talking about that institutes are struggling actually to get the deposits. CASA ratio is going down across sectors. How long can a deposit war continue, and who is better placed to win this war?
On the deposit side, what we see is that this deposit accrual issue is more structural in nature rather than being a blip or transitory. We will look at this from two angles. Firstly, from the demand side. So in terms of credit growth continues to be very healthy. Even for FY25, the house view on GDP growth is about 6.5%. And even if we have to extrapolate that to over the next few years, we see the GDP growing. If we see the GDP growing between 6 to 7%, then banking system credit growth is likely to keep pace with that, and credit growth there will continue to be in the range of about 12 to 14%. Now, if that has to continue, then deposit accrual has to keep pace. Now, coming to the supply side of it, what we've seen is that households, which have been the biggest contributor of deposits, they have been lagging behind, and validly so, because investments have been moving into financial assets like mutual fund investments, as well as insurance, as well as physical assets like real estate. So as a result, the incentive for the households to continue to contribute towards deposit growth has slowed down. Uh, Also, as you highlighted on the CASA ratio front, what we saw was that during COVID times, CASA ratio for the sector increased because both households were not spending as much, and even the corporates were not deploying the money. But coming out of that, we've seen that CASA ratio has come down. Now, CASA ratio is essentially the low-cost funds available to banks. And what we see now is that as interest rate cycle has played out, with repo rate increasing by 250 bips, we've seen some amount of that also move towards term deposits. Now, going into FY25 and towards the second half of FY25, we believe that there could be some monetary easing leading to a cut in repo rates. Now, as that happens, we could see some amount of the money that had flown into term deposits as the interest rate cycle plays out could return to the CASA funds as well. But on a net basis, we expect that the tightness for deposit accruals is more structural in nature, and that is something that will continue.
Okay, Karan, so that's a holistic, context you've set for us. But the accelerated rise of unsecured lending by NBFCs that we've seen over the last few months, how do you think that is going to play out? Is there going to be probably some asset quality bombs at the end of the cycle for us?
On the unsecured lending front, what we are also seeing when we look at the uh, top few NBFCs, approximately the top 10, 11 NBFCs, that this segment has reported very strong year-over-year growth in FY24. Now, when we look at the external environment with what RBI is doing or what RBI has called for, we of course expect that this sector will see a growth slowdown in FY25. Specifically, we expect the growth slowdown to be sharper on the personal loan side rather than the unsecured business loan segment. So all in all, as funding becomes a constraint for this segment, we believe that this segment is likely to see a slowdown going into FY25.
Okay, Karan, you have scaled back your rating on MFI as well. So in terms of what are the red flags that you see here?
So on the MFI segment in particular, our rating outlook continues to remain stable. What we have done is that we have, brought down our sector outlook from improving to neutral. And the reason driving this is that, we had put this improving sector outlook last year when we had come out with the outlook for FY24 for MFIs. And at that point in time, what we captured there was the fact that RBI had kind of taken away the spread caps for the sector, and they had deregulated the sector to allow them to do risk-based pricing, which has effectively led to an increase in their yields because MFIs were able to charge higher to the customers based on the risk profiling of the customers, and that kind of led to the improvement in their NIMs and thereafter PPOP margins. So that has played out, and now more recently, what we've seen is that there has been a soft nudge from the regulator, where the regulator has come out and said that while risk-based pricing is definitely to be done, but they should not be overcharging the customers. As a result of this, what we've seen is a few large players have already pulled back their yields by about 50 to 60 pips. So rather than having any concern, what we are effectively saying is that the improvement in PPOP margins that we were seeing because of this deregulation.
Okay, thanks, Karan, for that. Appreciate you joining us with that quick take on the BFSI sector. But on that note, taking a short breather on the show, don't go anywhere.